Welcome back, everyone. We are excited to present you to Brian Ormsby, who will be discussing the essentials of forecasting and accounting. Brian is, Brian, where is that? Oops. Sorry, Brian. Okay, Brian is the founder and the CEO of Pantheon Solutions. Pantheon specializes in providing compliance, accounting, and contract management for businesses that work in the government space. Pantheon is a partner with the Boulder Small Business Development Center to assist all small businesses with issues with accounting and finance. So, Brian, we will kick it over to you.
Yeah, thanks, Caroline. So, let me get started. Let me share some slides here, if I can find the slide deck, and we will get going. So, I'm going to put that in presentation mode, and okay, should be good. All right, so before I start, I wanted to let you know, I am a lead consultant with the Boulder SBDC as well, and I wanted to kind of give an advance to the Boulder SBDC. We'll be offering Leading Edge Entrepreneurship series beginning Tuesday, September 14th. So if you're interested in this 10-session series, please go to the Boulder SBDC website and sign up. It helps assist participants with building business plans and start and growing their businesses. So with that out of the way, announcement requirements, let's talk about accounting and essentials of forecasting. So first, what I want to do is talk about the whole financial concept, which is personal finances, business finances, how these things run together. I also want to talk a little bit about credit score, borrowing power, and then we'll talk about cash flow, and then finally we will talk about forecasting. So, one of the things that's really important in a small business is understanding that your business doesn't stand alone. Your small business and your personal finances are symbiotic. So if your business is having trouble financially, you're having trouble financially, and vice versa. So we need to make sure that we understand our business finances, long-term goals, your exit strategy in your business. And when we talk about exit strategy, this is kind of an interesting thing because most people when they start a business don't think about how they're going to leave their business. You know, it seems counterintuitive, but it actually is very important with what kind of business are you going to run? What are your goals? How long do you want to be in business? What are you going to do when you're not in business anymore? Do you want to build your business up to a sellable entity? Do you want to run your business until you don't want to run it anymore? And then when you're done, you close the doors and it's over. So exit strategy is very important, and it's extremely important because it sets the tone for your long-term goals. Personal finances, how they affect your business. So remember when you go out and you see that shiny new truck or the new boat, that may or may not put a strain on your personal finances that your business is going to have to handle. So consider these things together. What is your retirement strategy? Is your business playing into that strategy for you? And is your, I want to talk about this term lifestyle, which is on the slide. It means two different things. So on a personal financial level, lifestyle is how you are accustomed to living. So you want to make sure that your business finances are set up to be able to allow you to keep up that lifestyle. The other lifestyle I talk about is the kind of business. So I think about a business in terms of, is this something that we are going to build and grow and become perpetual, maybe at some point sell, maybe I turn it over to another principal partner, maybe I sell it to my employees at some point. That is a business acumen that is different than what I call a lifestyle business. A lifestyle business for me is the kind of business that you want to keep very simple, and you want to run it as long as you can do it, and then when you're done, when it's no longer suits you, you stop doing it and potentially you just close the doors. That is a lifestyle business. So when we talk about your lifestyle in terms of finances, we're talking about the way you're accustomed to living. When we talk about a lifestyle business, we're talking about a business that will exist and then not exist when you're no longer doing it, because it is based on you and you alone. So those things are important in kind of setting up that whole financial concept, how we want to look at this as we go forward. So the whole financial concept is also very interesting because we have to think about things looking forward, trying to stay ahead of the game. We don't want to get trapped. And when I say get trapped, I'm talking about these first two major bullets, which are credit score and borrowing power. So if you're going to make in your business what you consider a business decision that may have risk, you want to make sure that your borrowing power is at its fullest prior to making a risky decision. If you need to pull a line of credit, if you need to make a loan, if you need to do anything, maybe on your personal side, your car is 15 years old, it's got 300,000 miles on it, you know you need a new car. These are the things you need to consider before making a risky business decision. The reason is because once you make a risky business decision, your borrowing power has dropped. So when you go to a bank or a lending institution, if everything is roses, it's easy to get money. When you go to a bank and things look a little risky, it's really hard to get money. So consider these things in advance. You've got to stay ahead of the game. Think about your credit score. What will doing certain things do to your credit score? On a business side, you're Dun & Bradstreet. Do you need a Dun & Bradstreet? That's a whole different conversation. But if you're in the government space, yes, you do. Now, a Dun & Bradstreet number is required in the government space, and because it is required by the government, the Dun & Bradstreet number is free. You just have to tell them when you apply for the Dun & Bradstreet number that you're in the government space. So, but a Dun & Bradstreet number may or may not even be necessary for you as a business owner, but it is a credit score for your business. Most small businesses, when you're dealing with sole proprietorships, LLCs, which are the most common businesses, your personal FICO score is going to make the difference because you're going to be personally guaranteeing everything you do along the way. So consider the decisions you make and what is that going to do to your score. The higher your score, the cheaper money is to get. Now, doesn't mean that if you have an 800 credit score and you've just made a crazy risky business decision that you're going to get a loan, but it does mean that if you get a loan, an 800 credit score may save you 1/4 to 0.5% in interest. So these are things that are very important when considering your whole financial concept and how does this work for your business. So when we talk about looking forward, a key to this is cash flow. Cash flow is vital to, is your business, is your personal finances, is this symbiotic relationship going to work out? Because if you're tracking cash flow and you're hitting, you could have money in the bank. You know, a lot of people, they manage their business by, oh, I've got money in the bank, I must be good. Well, if every month the amount you have in the bank becomes a lower number, then you have a negative cash flow. And eventually, that's going to prove out to be a bad thing. So, I mean, this is common sense, but remember, when we're tracking cash flow, we need to know, is a negative cash flow situation going on in my business right now, is that something that is going to continue? So we'll talk a little bit about that when we get to forecasting, but what we need to understand before we do this is these relationships of When are you going to do what? How are you going to make your decisions? How are you going to stay ahead of the game and try not to go after funds when they're the hardest to attain? So after you've made a business decision that you have decided is risky, and then all of a sudden you say, oh my gosh, I need money. You should have said, oh my gosh, I need money in the front. Get a line of credit. If you don't use it, it doesn't cost you anything. Make sure that you've got that set up before you make risky business decisions. Because once you make that business decision, getting the money is going to be very difficult to attain. So consider these moves before you need to make them. So now let's talk about forecasting, because forecasting is the key to how we are going to figure out all of the things that I just talked about. So when we look at forecasting, we need to predict our revenues. We need to predict our expenses. The difference between revenue and expenses is cash flow in the end. So, I mean, if your revenues are $100,000 and your expenses are $80,000, then you've got a $20,000 plus in your cash flow. Now, that may or may not be a good story for you, depending on what you have to do with that $20,000 on a personal level, but it does tell you something. So what we want to do with forecasting is we want to look forward and try to figure out what is going to happen in the future. So I tell people all the time, forecasting is the hardest thing you will do in your accounting world. So when we start looking at forecasting, we need to first look at the next 12 months. Once we can figure out what the next 12 months look like, then we need to look at months 13 through 24. And we need to keep that going, which means that we don't create a forecast every fall. We don't create a forecast, every spring. We create a forecast and we maintain a forecast every month. So it's a very difficult thing. If you're a pre-revenue company, then forecasting is extraordinarily hard. It's a lot like, when you create your business plan for the first time and they say, so, what's your 5-year revenue look like? And you're like, I have no earthly idea. So when we start looking at forecasting, the idea here is to ground yourself and then start looking forward. The further you look forward in your forecast and the more data you collect on a monthly basis, trying to kind of bring that forecast to fruition, then the better off you're going to be. And every month your forecast is going to look a little better. So let's talk about revenue predictions first. Revenue predictions are, sometimes they're easy because you have things lined up and you can see them and you know exactly what they're going to be. Sometimes it is a total crazy guess and you're trying to figure those things out. And I say, well, what we want to do is we want to reduce the WAG, wild guess, out of the revenue prediction forecasting. So how do we do that? So we try to come up with actuaries. So if you're a pre-revenue company and you don't know how things are going to go, let's figure out what's an actuary that if I put so much effort into the game, how much should I expect back? So this is part about research. This is part about learning your business environment, learning your competitors, your customers, the whole gambit, right? So we'll get down to, I used to work for a simulation firm, and I'll use this as an example. We would submit proposals to the government every quarter when the announcements came out. And our history told us with every number of proposals that we submitted, we would win a certain percentage of those proposals. So that is a good way to predict revenue. So if I know I'm going to win 1 in 5 and I submit 5 proposals every quarter, then I can expect 4 wins a year. And those 4 wins a year depending on the proposal I'm writing and the value of the contract I'm proposing to, can give me a revenue prediction. So think about that in terms of how do you do this. So everyone is different in your space. Now, I think in almost immediately consider the government space when I'm thinking about predicted revenue and stuff, because that's where my experience base is. But if you are a clothier or you are a brewery or a restaurant, how do you predict revenue? How many customers are going to come through your door? What's the average ticket? How many days are you open? How many hours a day are you open? These kinds of things are predictive of revenue. I do caution you when you start putting these things together to really pour the revenue model through. So I'll give you an example. Years ago, I used to be in the indoor tanning business. So my wife and I decided to buy a tanning salon, and we looked at buying new tanning beds, and the tanning bed company sent us a revenue predictor saying that there were 20-minute sessions, and if we had 3 people per hour per session and we were open 10 hours a day, that then we would see 30 people and our revenue would be this. Now, that was a horrible revenue model. And the reason is because you can't put 3 people per hour in a 20-minute session, because they have to go in, they have to get ready, they have to put when they get out, some people are putting on lotion, so there's all kinds of reasons why you can't turn people in this cattle call the way their revenue predictor had said it would be. So their revenue prediction was completely off base. In fact, it was very difficult, we found, to turn 2 people an hour, just because of the prep time for someone when they got into a tanning bed to get into that mode of tanning, to get back out of that mode, get themselves ready to meet the world again. So when we think about revenue predictors, think about the common sense. Actually walk through the process yourself and see, can this happen? For example, if you are a restaurant and you say, okay, well, we have got capacity for 100 patrons, and if we can meet a 75% capacity and we can turn those clients every 30 minutes, what would our revenue be if the average ticket for 4 people were $60? So when we look at that model, think about, is it reasonable that we could reach 75% capacity all day long? It may not be. There may be hours of the day and the month where 75% capacity is completely unattainable. And there may be hours of the day of the month where 75% capacity is way under what's going on. So we want to come up with this rhythm of maybe 3 o'clock in the afternoon your capacity is 10%, but 6 o'clock in the afternoon your capacity is 95. Can we turn people in 30 minutes? Is that reasonable? Or should it be 45 minutes? Or should it be an hour? So when we think about revenue predictors, we have to think about the rhythm of your business, whether it's my indoor tanning example or a restaurant example. Doesn't make a difference. It's your rhythm and your business. So that's what you have to look at. For example, another good one is a brewery. What's a healthy number of beers for someone to consume? If someone stays in there for 2 hours, you don't want to count them for 10 beers. That would be a really bad model for you and your business in general anyway. So we have to consider what makes sense in terms of revenue and revenue prediction. Okay, so I think I've kind of beaten that one pretty hard here. But again, think about your business. Every business is different. How is this revenue going to come in, and what makes sense? Now, when we're building the forecast, every month we have data allows you to create a more finite process. So as a month goes by, we can look at that revenue prediction. We can decide, is that a good number, or are we going to grow? Or did we have an incredible month because it was our grand opening and now we expect things to kind of settle back to normal? Or, like In-N-Out Burger, is there going to be a line around the corner every day? So let's think about those things when we talk about revenue predictions. Now, let's talk about expenses tied to revenue. So for every sale, there is a cost of sale. Now, you may or may not in your accounting system have cost of sales or cost of goods sold, depending on what kind of business you are, but it doesn't make a difference. There are certain expenses that are directly proportional to your revenue. So as your revenue goes up, those expenses will go up. As your revenue goes down, those expenses will go down because they're symbiotic. So we need to look at those expenses, try to figure out, if you're a restaurateur, you understand this because you have what they call labor costs and food costs and beverage costs and those things. And those are calculated as a percentage of your revenue, and those are the numbers you're supposed to hit. Because if you hit those numbers, then you know you'll be profitable. So when we think about these revenue predictors for businesses, we also have to think about the expense predictors against that revenue. So that part sometimes is easy, but again, as we forecast and we get further and further down the road, we will get a percentage that we can count on, that we know that this is how business is done. But we can use the model. I think about, I think it was Taco Bell, but I may be wrong, stopped handing out straws except on request. And then they found out corporate-wide across all Taco Bells in the world that saved them over $1 million just by not handing out straws until someone asked for it. But how many times do you still go to a fast food restaurant, go to the drive-out, and they throw a fist of ketchup or a fist of hot sauce into your bag? Think about how much revenue that's costing the company because they haven't defined that process. So when you're running your business, you have to think about everything. Think about all of the little things and how does it save you money to maybe just don't serve it unless they ask. When you go to some restaurants, every time you sit down, they put down a glass of water in front of every person. Well, now maybe that water you don't think costs you any expense, but those glasses have to be washed. There is an ice machine. There is maybe a straw. There is the water that comes out of the tap that hits on your bill. If you think about what that costs, as opposed to putting a sign that says water available upon request, these are things that are cost to your business. And it's good for the environment, so everybody wins. So think about these things and revenues tied to expense, because just because it's tied to your expenses are tied to that revenue doesn't mean it has to exist. So there are some reasons and some ways to streamline that process that can save you money. Now, fixed expenses are the next thing. Fixed expenses are things that do not change until you change the nature of the expense itself. So we think about rent, think about a company car, things that no matter what you do, the rent is always going to be the same or will be the same with some level of escalation year to year to year. So fixed expenses are a little bit easier to predict, but they also create a level of risk because they're not tied to your revenue. If your revenue goes down, the percentage of fixed expense to what's total going on in your business is much higher. So we have to kind of look at these fixed expenses. Although they're fairly easy to predict, they can be very difficult in terms of profitability. So, and they also become the biggest risk when we start talking about decision making. Do I go to a bigger space? Do I, want to get a car for one of my executives? Things like that really can hit your bottom line, and it all sounds rosy at the time when your revenue's great, and then something happens, your revenue dips, and all of a sudden the fixed expenses are eating you alive. So in your forecasting, fixed expenses, although they're the easiest to forecast, they can be the riskiest when it comes to, is your business profitable? So we talked about, I've done this kind of understanding the relationships, and I've hoped that I've kind of talked about that as we go through. And I want to kind of go into this revenue model. Now, I have a revenue model that I am glad to share, and I will give to the presenters of this meeting so that people can request it, and we'll hand out for free. So I'm going to talk a little bit about my revenue model, and you won't see it, but when we do, if you do request it, it'll make sense. Now, if you use my revenue model, which is very basic, or any other revenue model, honestly, it doesn't change. The concepts of, and I say revenue, it's really forecasting. The concepts of forecasting are the same. So we'll have a tab in there that talks about revenue predictions, which we've talked ad nauseum about. We'll have a tab in there that talks about expenses tied to revenue. We'll have a tab in there that talks about fixed expenses. There'll be another tab in there about like major purchases, so you can sit down and say, well, we're going to buy a new grill, or we're going to need a vacuum seal machine, or we need some kind of vacuum former, or we need a heater, or there's so many different fixed assets that you could buy depending on what kind of business you have, that you need to make sure that you account for when you're going to buy that and when you expect to buy it. And there's two ways that we have to look at this when we go forward. So obviously, how you buy a fixed piece of equipment, whether you are going to pay for it in full when you get it, whether you're going to finance it, either lease or some kind of purchase arrangement. Either one of them is going to have some type of expense of interest tied to it, and payments going forward. And then how is that going to depreciate? Because one affects cash flow of how much money is actually coming out of your account when, and then the other affects depreciation, which affects your taxes, which in the end will affect cash flow again. So we have to look at fixed assets and look at both ways that they're accounted for in your system. So, and we talk about forecasting, let's talk a little bit about your accounting system. So how you account for things in your system is what makes sense to you. And I like to talk about this a little bit just because I see small businesses will look at bigger businesses and their accounting system, and then they will try to duplicate or emulate that system. That's not necessarily a good move. You should keep your accounting system as simple as you possibly can, but with enough detail that makes sense to you. So if you, for example, you could have a line on your accounting system that says utilities. Utilities could be gas, water, electric, phone, it could be a whole number of things. And it could be gas for the car for all that matters. It really depends when you're tracking utilities, does it make sense to know how much your gas bill is, vice your electric bill, vice your water bill, vice the gas that you put in your company car, so on and so forth. Only put that level of detail into your accounting system if it makes sense to you. So, because you're going to forecast the same way. So you forecast at a level of detail that makes sense. If these bills are not generally important to break out, then don't do it. Now, bigger firms break out lots of things. They have accounting staffs, they can do this, and whether or not they use it or not really doesn't make any difference. It doesn't cost them any extra money to do that because they already have 5 accountants on staff. Well, small businesses don't have that luxury. So let's think about your accounting system and keep it simple. And in that, it will also keep your forecasting simple. Okay, so I'm going to see what my next slide is. So my next slide is a wrap-up, and it seems awfully early. So let's go back and let's talk a little bit through this wrap-up about some of the things that we talked. So let's talk about this whole financial concept. The whole financial concept. What's important in your personal finances, what's important in your business finances are symbiotic. So we have to know that in my personal finances, anything that I do, anything that I buy, I want a new house, a car, so on and so forth, potentially put a burden on the business if the business is how that I get paid. So in your business finances, if your business is profitable, not profitable, so on and so forth, are those things going to affect your personal finances? So unless you're independently wealthy, which I don't know very many people who are, these things we have to look at together. Talk about our credit worthiness, and when is it important to get money and funds. So money and funds are extremely important to every business, and it's always a good idea to line these things up way in advance and make sure that we have plenty of funds on hand to use when something happens, and not make a risky decision and then try to go find money. So that borrowing power aspect, we have to look at when is the most important part of that. And then cash flow and forecasting, and we'll go into a little bit more about this. So as we're doing our forecast, as we're predicting our revenue, every month we go through, we predict revenue. So I always say start with the next 12 months. So if we're going to start a revenue calculation right now, we would look from August to next July. We would take all of the data that we have from zero to maybe you've been in business for 5 years, and we can go back and look at 5 years worth of data. But you know, the nature of this being startup week, I would say that there's probably no one listening to me that's got 5 years of data. So we want to take all the information that we have. If we have no information, then we need to do research. We need to look at like businesses in our space and figure out what can be predicted from that and try to create a revenue model. So if you're pre-revenue, this is extremely difficult. But keep at it, you'll figure it out, because once we do this August to July forecast, then we will get August done, and then we will have a September through August forecast, and we'll have some data. And then September will happen, and we'll have an October through September forecast, and we'll have more data. And as the data streams in, the numbers will get smarter. So that's rule 1, 12 months forecast. Rule 2 is 13 through 24 months forecast. We need to make sure that we are not just looking at the next 12 months, but we're also looking at the 12 months after that. Now, the information is going to be fuzzier, right? We won't have as much data to go by, and it will probably be more about futuristic planning than actual numbers. But every month, update our forecast. We continue to slide those months out to the right. So the next 12 months represents a little further down the road when we're thinking about today. And then the 13 through 24 months should get clearer and clearer and clearer. So it allows you to then make business decisions, because now I've got a plan that says, what do I think it's going to look like 18 months from now? How am I going to get to that point? And I don't know, throughout my entire life, everyone always told me, you know, have short range, long range plans. And most of the time, I would just kind of go, yeah, whatever. And, because short-range plans, I know what I want to do tomorrow and next week, and that's really not short-range plans. Short-range plans are what are we going to do for the next 12 months? And long-range plans are what are we going to do from the 13th month to the 60 months or retirement. So how are we going to get there? And this forecasting, if we only do 1 year of forecasting, then the long-range plans are never considered. So going back to making sure our forecast goes out at least 2 years, it would be okay if it was 3 or 4 or 5, because a business plan should go out 5 years. And then looking at our personal finances, well, how do we get to retirement? How am I going to, put my feet in the water and the beach on the Gulf shores? Maybe that's my retirement dream. How am I going to be drinking Mai Tais in Cancun? Maybe that's my retirement dream. So we got to figure out how we're going to get there. And, if you're my age, I don't have a whole lot of long-term plan on that anymore, because I'm a lot closer than I ever thought I would be. Now, with that said, had I done planning 10 years ago or 20 years ago, I'd be in a much better place than I am now. So this is the importance of this planning and forecasting, not only for personal life, but for business life. So now what I want to do, even though we're in this wrap up, I kind of want to go through a few scenarios with the different styles of businesses and talk about how that would roll through forecasting. Maybe those examples with the kind of business you're in will ring true, hopefully. And if not, you can hit me in the questions phase, and then we will discuss your particular situation. So let's go back to one of the first business I ever owned, which was a tanning salon. And I'll give you a little history on that. I was extremely bored. My wife was extremely bored. Both of us had just left the military, and we were looking for challenges. And so I had a friend that had a tanning salon that was getting ready to relocate and was trying to sell it. And my wife and I just had a wild hair, and we bought the salon. And so from that tanning salon business, when we bought it, we sat down with our friend and we looked at how many customers they had. We looked at how many hours they were open. We looked at how many beds they had. We tried to do a predictive model of how much money we would make, and we were so wrong. So this, in terms of when I talk about getting a new business, is how is this forecasting going to work for you? Well, in a new business, it's tough, because even though it was a friend of mine, I think he was trying to put rose-colored glasses on us because he really wanted to sell. So, we found out that just because you had 500 customers in your customer log and you were open 12 hours a day, didn't mean that you were going to have any revenue. And quite frankly, when you get in the middle of November, a week before Thanksgiving, you can sit in a tanning salon all day long and no one's going to show up. So we found out the hard way that our revenue predictive skills were quite lacking. So what we decided to do was to, kind of create a predictive model. And so we did, like I'm talking about now, is tried to come up with initially a 1-year plan of what revenue was going to look like. And, we talked to manufacturers of tanning equipment and looked at their revenue predictive models, which I gave an example of earlier of one that was given to us that was just, totally optimistic and not attainable. We looked at our actual numbers. Unfortunately, one of the things in being a new business owner is we didn't get a lot of revenue data from the person we bought it from, which was a huge mistake on our part. You should be getting that kind of information by the person that you buy from, making sure that you have some real numbers to go by. Like when you buy a house, you should be asking them, hey, what's your average utility bills? Can you send me your last 12 months of bills? Same kind of thing when you buy a business, is find out what kind of revenue did they achieve in the last 12 months before they sold it to you. If you can get 2 or 3 years of revenue, even better, because now you can find out whether that business is growing or declining. And maybe declining is the reason that they're selling it. So in the case of trying to create a revenue model for this business, of course, you know, my wife and I were crazy go-getters. We're trying to figure out how to generate more revenue. So what did we do is we branched out into more things that even cost us more money. So you look at these models and you think in desperation, because we didn't know what we were doing, we decided that we would develop our own tanning lotion brand. So we contacted a chemist in Chicago who made us 3 different lotions. We contacted a graphics artist and created a design for a logo, and got with a bottling company and got bottles and bought an apparatus where we could fill the bottles ourselves. So now my kitchen was a manufacturing lotion facility, and we continued to lose money hand over fist because we had no idea what we were doing in that business. We had no revenue predictive model. We had no idea how we were going to take it to market. And it was a wholesale disaster. So when I look at these things and I look back in my experiences, I guess that's why I'm standing here, is because I can relay some of these, you know, personal. They weren't tragedies. They were very trying times, and the fact that my wife and I are still married after all that is probably the most trying. So, you know, considering how this works through, we have to come up with this revenue predictive model. So think about your business, think about where you're going and how that's going to work. Now, I am going to wrap up and go for time for questions because I think I've hit my moment.
All right. Thank you so much, Brian. That was so interesting and so great to hear your personal stories as well. It's, you know, it's wonderful to be able to learn from others. And so, first question here, we have an anonymous attendee asking, how do you handle revenue forecasting when your historical data from last year is significantly skewed from the pandemic?
Yeah, and that's the same thing. It's almost like pre-revenue, where you have to try to do a predictive model based on what you think it should be. Remembering that the pandemic is a great lesson for us to learn because no one thought it could get this bad. So no one predicted this in their revenue. So consider, you know, when I have a company that actually does 3 revenue forecasts. They do an optimistic, a baseline, which is what they really think is going to happen, and they do a pessimistic. And the pandemic has changed their pessimistic forecasting dynamic entirely. So it's really hard because the pandemic gave us many, many things that we didn't see coming. But that's something that you need to look at. Should we put together a revenue based on what we think would happen without the pandemic? And should we also put together a forecast if the pandemic were to continue? Because we've got new Delta variants and things like that. Maybe this goes on for a lot longer than we think. What does that look like in our revenue predictions?
Okay, and this second question is, when conducting a revenue forecast, do you do a low, a high, or just an average? So I think if you want to.
Yeah, no, I mean, again, what I'm saying is I think it's probably a good idea to create a baseline revenue model, how we think this is going to happen, the most realistic possible case forward. And then now you've got a spreadsheet that's fully populated, so you can make more copies of that. You can do an optimistic predictive version of that, a pessimistic predictive version of that. You could come up with what if our revenue was 10% more? What if our revenue was 20% more? So you could make as many models as you want. They could all be linked together, so when you change one, all the rest of them change, and then you have all the data to look at.
All right. And thank you for offering your revenue model. I will definitely be asking for that. And so just building upon that, apart from Excel, are there any other tools that you recommend for new small businesses or entrepreneurs?
Well, I mean, I think a spreadsheet-based revenue predictive version makes the most sense. And because you don't have to go out and spend money. I think everyone has a version of some spreadsheet, whether it's Google Sheets or Excel. So that makes sense to me, so you're not spending money. I mean, there are many, many companies out there that do forecast models for a fee. You know, if you've got the cash, there are some fantastic systems out there. But realistically, no one knows your revenue like you do. So you sitting down and working through your forecast, and I keep saying revenue in terms of forecast, but no one knows your business like you do. So doing your own forecast makes the most sense. Paying someone else to do it, that may be fantastic and they may have a fantastic tool. They don't know your business like you do. So are you going to get what you're looking for? And quite frankly, most of them are pretty expensive.
Okay, thank you. And what is the most frequent mistake that you see small businesses make in regards to forecasting?
So we use a term from Winnie the Pooh. So Winnie the Pooh has two famous characters, Rabbit, who's very optimistic, everything is going to turn up daisies. And we have Eeyore, who is just the world is coming, the sky is falling. Eeyore is, oh gosh, it's going to be horrible. Don't be a rabbit, don't be an Eeyore. So if you are that kind of person, then be both. So what I'm trying to say is we want to find this middle. So if you create an optimistic rabbit-style forecast and then an Eeyore-style forecast, reality is somewhere in the middle. So the biggest mistake I see is people either bring their pessimism or their optimism. Most people who are small business startups are optimistic. So don't be overly optimistic. Try to be realistic.
Okay. And, well, sorry, there's a question here about getting a copy of the revenue model and getting the slides. So we will send those. We'll send those out afterwards, correct?
Yes, I'll provide that to the group here, and then you can get that from them. If for whatever reason that system falls through, my email's right here. You can contact me, and I'll send it to you directly.
Okay, great. Okay, and then we have a question here about credit score and how can I better build my borrowing power?
Well, I mean, borrowing power is based on two things. Credit score is part of that equation, but the other part, and I say this, and it's a pessimistic thing to say or maybe cynical, is that if you need money, go to the bank, you'll never get it. If you don't need money and go to the bank, they'll give you a loan tomorrow. So, and that's why I use this in my presentation, and I stress it so much, is don't go looking for money when you need it. Look for money before you need it. But you know, the whole credit score is based on how long have you had credit, how much credit do you have, what is the percentage of debt to credit, and have you missed any payments? So, you know, you have to really kind of live a good life in the credit world.
Okay. Okay, and so on the one more question here coming in, we have, so you said to build your forecast 12 months out and to do monthly check-ins. Is this something that you are typically also checking on a daily basis?
No, don't overthink it. You know, if you do it too much, it'll drive you crazy. It's kind of like watching the stock market, right? So if you watch it every day, it will drive you crazy, and your forecast is the same way. What you want to do is you want to keep a good set of accounting records. You want to close your books every month, and then you want to update your forecast based on your last month's close.
All right. Okay, well, thank you so much, Brian. I think that is the rest of our questions. So thank you, everybody, and we will, any follow-up for the revenue model, we will get that to you. And up next, we will take a 10-minute break, and up next we have a discussion on customer acquisition and retention and curating the right sales team. Thank you again, Brian.
You're welcome.